Very good evening to all of you. Welcome to today's YouTube live practical session number 21 for the year 2024. Myself, Sujit Kakar, and today is Sunday, 2nd of June 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So today's session is our practical application of demand supply methodology. So the demand supply course, which I used to teach, was a paid course, but now we have made it as an absolutely free course. In case you people have not gone through the course, the links are available in the description. And even during the session, if I talk about some videos or if I talk about some documents, those links are available in the description. You'll be able to access those documents or those videos by using those links. I would also like to add that the course is available in both the languages, English as well as in Hindi. So this is our English channel. The Hindi channel is called as Trading Munch, for which the link is again available in the description. So if you're more comfortable in Hindi, you can also access that channel and you can learn the complete methodology. Now, what we do in today in these weekly sessions is that whatever you have learned in the demand supply course, which is the theoretical part, we apply to some practical examples so that we can understand how to plan trades in a very mechanical and rule based way. And that is what we'll be doing today again. But before we start with today's practical example, we do have some trades from the past which I shared with you and they got triggered this week. So we will start with the review of them. So again, just because I'm sharing some these examples with you does not mean that I just share them and then we forget about it. Whatever ideas I'm sharing with you, whenever they get triggered in the future, we will definitely be reviewing them. So we do have three of these examples which got triggered in this week. So we'll start with the review of them and then we'll start with today's example for the analysis. So the very first one is this, and this was our session number 13th, which I did on 31st of March 2024. So just in case you want to see the session where we did the analysis, that's going to be the 13th, session number 13th, which was on the 31st of March 2024. Now, when we did the analysis for this was a 10 out of 10 zone for us and an 8 out of 8 score for the probability, which made it as a type 1 trade. Now, when the prices are coming back into the zone, you can see the prices came back into the zone on the 30th of May, which was on Thursday, and we have already started getting some reaction from it. But the question here is that did we have good reward to risk ratio when the prices were coming back? So if I try to identify where is my opposing fresh area of supply, you can see we don't have any supply anywhere close by. So what I can do in such a case when I don't see a specific target for me, you have two options. Option number one is you can go for 2:1 as your mathematically calculated target, or maybe even 3:1, whatever you're more comfortable with, and maybe at your 2:1 or 3:1 if you want to book some partial profits, that can be done. But because the chart is not showing me any opposing zone, the best approach can be just to keep trailing onto this unless and until you get stopped out of this. So trailing would be the best option. So that's your that's your uh, very first example which we just reviewed, and like I said, we did the analysis for this on the 13th, no, it's not on the 13th, on the 31st of March, and this was our session number 13th for the year 2024. All right, so now that we are done with this one, let's also look at the other two. Give me a second, I'll bring them up. Just a few more seconds. All right, so I'll just bring up the next one. Okay, this is right here. Perfect. All right, so that's the next one. This was our session number 17th, and the session was done on the 5th of May 2024, and you can see prices came back on the 31st of May. So we've just hit the proximal line, and I won't even say proximal is always a little below. That's our entry price, so that is where we just hit on Friday, getting a very small reaction as of now. So we'll see how it progresses. But the challenge with this trade setup is that you can see when the prices came back into the zone, our opposing fresh areas right here, which is only showing us a reward to risk ratio that is a little over 1:1. So the problem with this setup is that your reward to risk ratio is not really nice. And if you look at the analysis of this one, we had a score of 10 out of 10 for quality, but 4.5 out of 8 for probability, which definitely made it as a type 1 trade, but this was not at the best location. And since we are not at the best location, we can't even take our targets from the intermediate time frame. Target has to be from the lower time frame. So if you talk about this setup, when the prices came back into the zone, yes, ideally we should not be taking trades for such small reward to risk ratio. So we should have skipped this trade setup. Therefore, we'll say because the reward to risk ratio was missing at the time of arrival, this trade gets disqualified for us. And the last one which got triggered, let's also review it. Give me a second. Let me bring that up. All right. So that's the last one. So this one was your session number 19 for the year 2024. The session was on the 18th of May, and you can see we came into the zone on this particular day, which was 28th of May. Now, if I just do a replay, give me a second. Perfect. So you can see if I do a replay when the prices came into the zone, and if we were looking for where is the opposing zone for my target, then you can see that is where we had a formation of a supply area, which is this drop based drop. And if you again talk about the scoring, we had a score of 10 out of 10 and 6.5 out of 8, but this was not at the best location. And again, since we are not at the best location, the target has to be from the lower time frame. And from the lower time frame, you can see we only have a target which is about maybe a little less than 0.5, nothing more than that. And if you were looking for this as your very first target, though we should not be taking trades for such small targets, but you can see if you were looking at this as your target, then in about 3 to 4 days, that target was achieved. In fact, we also hit the next zone. But again, going with the rules, I'll say that the reward to risk ratio was missing, due to which this would have disqualified by the time prices are back into the zone. Now, let me add one more thing here. See, whenever we go through these sessions, I always tell you that the rule book that I've shared with you is a conservative approach, where we are definitely looking for at least 2:1s or 3:1s as our target one. But understand that eventually, as you have more and more experience, you can look for other factors which might be giving you some extra edge. And if you have some factors, uh, probably, if you want to again go to the intermediate time frame for your targets, like we do in the case of best locations. So again, best location is a positive factor, right? That's the reason we go to the intermediate time frame for our target if the lower time frame is not showing us a good reward to risk ratio. So the same thing can also be done, not just based on one factor, which we covered in the rule book, that is the best location. There can be other factors as well, right? So based on your experience, if you feel that you have some factors which are giving you a little edge, and even if your reward to risk ratio is not really nice, you still want to get into those trades. Maybe the very first target you want to book, quickly book some partial profits, and rest of it maybe you want to keep trailing onto it. So all those modifications can be done. But while we are reviewing, we will be following strictly our rule book, where we will be going with a very conservative approach. All right, so that takes care of these trades which got triggered. Two of them will say will disqualify them because of the reward to risk ratio missing, and one of them will be tracking it, and we'll see how it progresses eventually over the next few coming days or coming weeks. All right, so just give me a second. Let me bring back the one which we will be analyzing today, and then we'll start with our analysis part. Perfect. Great. So, whenever we talk about trading, I always say trading has to be a very mechanical and rule based process. Now, why it should be mechanical and rule based, I have explained this in a video, and the title of that video is How to Start Trading. In case you have not yet watched that video, the link is available in the description. Go through that video, and also follow the process that I've explained, because there is no bypassing it. Eventually, everyone will have to go through that process. So, the sooner you start, the better it is going to be for you. But now, what happens is, yes, it is easy to say, you need to create a trade plan. But when we start learning trading, or maybe when we start learning a new methodology, like in this case, demand supply methodology, because of that lack of experience, because you have just started learning, it's not very easy to create a trade plan. And to overcome this challenge, I have created two documents for you. One is called as your trade plan steps. You can also call it as the flow chart or the walkthrough. Now, this guides us what we need to do as a demand and supply trader step by step. And all these steps, they have their own elaborate rules, which are available in the rule book. So like I was just talking about some time back, that this rule book is a conservative approach. With time, with experience, you can definitely modify to make it better suit with your personality style. And also, as in when you have more experience, some modifications can be done based on that experience. So what is our step number one when we start planning our trade? Our step number one is we need to define our trade purpose. And what is the meaning of trade purpose? Trade purpose implies the expected duration of the trade, and the duration is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts. And the very first challenge we face is that there are so many time frames available to me. So out of these a number of time frames, which time frame should I be using for my analysis? And this is where our step number one comes in play to help us decide our time frames. So the logic that we apply here is that the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. And that is the reason we are choosing our trade purpose as a step number one, because based on the expectation of how long the trade can be an open trade before I get the exit, we'll be selecting our time frames. Very simple logic. Longer durations, bigger time frames, smaller durations, smaller time frames. So what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, by definition, I definitely said that daily income is a trade which can last for a day or few days. But if you talk about markets which are not open 24 hours, then I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up, some symbols they gap down. Now, if I take example of NSE, if you're trading the NSE exchange, you will see that almost every other day when the market opens, some stocks they gap up, some stocks they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, by keeping that position overnight, we have that inherited overnight gap risk, which we would like to avoid initially. Why? Because when we are learning something new, we don't have expertise from day one. And that is where it definitely makes sense to practice risk management by not taking that unnecessary overnight gap risk by keeping these positions as overnight positions. So that is the reason initially our hourly dailies will be strictly intraday trades. Weekly monthlies, anyhow, we are not anticipating we'll be getting the exit the same day. So we have no choice but to keep these positions as overnight trades. But as you start having more and more experience, if you want to include daily incomes into overnight trades, that can definitely be done. And I would also like to add that just because you're doing weeklies and monthlies, that does not imply that for weekly monthlies you cannot have gap against you. It can still happen. But the probability reduces a little bit because we start leaning against some bigger time frames. So step number one was I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now once I've selected my trade purpose, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with the topic that is multiple time frame analysis. Because demand supply is not based on single time frame, demand supply is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames. We call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate for trend. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case you need to apply some additional rules, that is also where this time frame can help you. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Again, this table, which is page number 31, is for the NSE exchange, which is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer duration, then you can refer to the table, which is on page 32. This can be used for commodities, for forex, for cryptos, right? So again, choose the table based on what markets you are looking into. Now, because I opted, I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss entry target and size. And in case I need to use the refining time frame, then my refining time frame will be the 60-minute chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules. That is also where this time frame can help us. So as soon as I'm done with my step number one, I have the clarity to what time frames I'll be using, but plus what is going to be the purpose of each and every time frame. So my challenge number one is taken care. The next challenge is, yes, I do know my time frames, but let's take example of NSE. On NSE, we have over 2000 companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need now is a process for selecting scripts that out of these 2000 companies, how do I get a smaller list? Because if I have a small list, I can do my analysis almost every other day. But if every day I have to sit and analyze 2000 companies, it's not an easy task. So the way we do this is by using certain computer programs, which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then the scanner screener identifies that out of these 2000 plus companies, which one are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very, very important thing which you always have to remember, no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks. The job of the scanner screener is never to tell you what you need to buy or sell. The job of the scanner screener is to give you a smaller list out of those, bigger list which is available to you. And once you get that smaller list, you need to analyze all these symbols one by one and identify which one of these are matching with your trade plan. The one is which is an exact replica of your trade plan. That is the one you will be going for. Anything that does not match with your trade plan, you simply skip it. So a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you. And these scanners are based on some moving averages, which will help you in shortlisting symbols. Second example, if you search on my website, on my YouTube channel, if you search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, if you search on my YouTube channel for top-down analysis, you'll also be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples using which you can get a smaller list, but let's look at few of them before we move on to the next step. So like I was talking about, that once you go to my website, under the free tab, you have stock screener. Because I opted, I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 3 symbols for me, and the short scan is not shortlisting anything for me. Now, very important, like already said, just because I got a list of 3 symbols from the long scan does not mean I will blindly buy these 3. And similarly, if I was getting some results from the short scan, does not mean I would blindly sell those symbols. So the job of the scanner was to give me a smaller list out of this bigger list. And you can see from 2000 companies, 2000 plus companies, it shortlisted only 3 for me. So I can analyze now these 3. If any one of these match with my trade plan, they can be my trading opportunities. If nothing matches, I'll be skipping them. Now, many times what can happen is your list can be very small, like you can see today, or maybe you're not getting any results because nothing is matching with these conditions. Or even otherwise, if you feel that if I'm looking at a very small list, I might not be able to find opportunities, maybe I have to have a little bigger list to start identifying my opportunities. Then you can see that in this scanner, I've given you 5 different conditions. You'll disable the third one and you'll run the scan again. And I'll do exactly the same thing for the short scan. I'll disable the third one. I'll run the scan again. And now you can see that initially I was only having a result which was 3 symbols, but now it is giving me 76. And if I go to the other one, we have uh, 13. So we have 76 plus 13, which is 89 symbols to look into. So it's not that you have a list of 500 or 600 symbols to look into. It's still a very small list, just about 89 symbols, which can be easily analyzed, I'll say probably in half an hour, 45 minutes. But if you still feel it's a big list, you further want to filter it out, you can use different filters. Like I can say, I don't want cash segment. I only want the ones which also get traded in futures. And I can also do exactly the same thing instead of cash futures. And now you can see I have a list of 31 plus 8, which is 39 symbols to look into. So this is how you can have different conditions, different filters based on which your list can be smaller, your list can be bigger. And this is just one example of screener. If I go to the screener section on this website, you can see you have over 150,000 screeners available to you. Some are based on fundamental analysis, top loved. Then you have candlestick patterns. Then you have your range breakouts, bullish scan, bearish scan. Then you have your intraday bearish, intraday bullish crossovers. And this is just one website. Similarly, if you do a Google search, you'll be able to find a number of websites, a number of scanner screeners, whatever you feel is the best fit for you. That is the one you can use to start getting a smaller list. So in this example, you saw we got a list of about 89 symbols to look into. Now, once you start analyzing them, there are few challenges which you will face. So challenge number one, what you will realize is that you're wasting a lot of time analyzing such symbols where you don't have any quality demand zones or supply zones on the lower time frame, which means you don't have any quality zone available to plan a trade. But since those symbols have been shortlisted, you have no choice but to analyze them. And the reason for that is because all these 150,000 plus scanners we talked about, none of them are based on demand supply zones. They're either based on fundamental analysis or technical analysis. And just because something is getting shortlisted does not guarantee that you'll have a quality area on the lower time frame. So that's the very first challenge. Now, a few of these symbols which might have quality demand area, supply areas, they might be far away from the current market price, due to which you might have a longer waiting period before the prices are back. And during that waiting period, wherever price action develops, it can also disqualify that particular trade setup for you by the time prices are back. So these are some challenges we face, and to overcome these challenges, I've also created two custom built tools. One is called as the alert service and the other one is called as the screener. Very important, these are not call giving or tip giving services. These are again scanner screeners. Only difference is that both of them are based on demand supply zones. Now, just to show you an example, if you talk about alerts, what alerts basically do is that as soon as you have a formation of a demand area or a supply area on the lower time frame, it immediately notifies you. Now, we do have the demo channel for alerts for NSC. We also have the demo channel for MCX. We also have the demo channel for Forex. Once you go through the description, you will find the walkthrough videos for alerts and screener, both of them. And in those videos, I've explained how you can access these demo channels. So you can see for the NSE channel, what we do is during the trading days from 11:15 to 11:45, we keep updating you with the alerts as and when these zones are getting formed. So these alerts are live, these are real time. So as soon as you have a formation of a demand area or a supply area, you'll get these notifications. And the information we get is at what time we got the notification, what is the name of the symbol, what is the name of the zone, whether it is a drop based rally, rally based rally. Then you can see drop based rally, then we have drop based rally, then we have again rally based rally. So you'll get to know the name of the symbol, on which time frame it was formed. Here you can see 5 minutes, here is again 5 minutes, 15 minutes, 5 minutes, right? Then you have on the daily time frame, so it will also tell you the time frame. And what is the proximal value, what is the distal value, that is also the information you get. Again, very important, these are not call giving or tip giving services. Alert is just helping you identify symbols where you just had a formation of a demand or a supply area. And once you get that information, you will have to match these zones with your trade plan. Only if they qualify as per your trade plan, they can be your opportunities. And the second tool we have is the screener. So what does the screener do? Let's look at an example. So here you can see on the screener, I have added about 40 symbols, and then I've said that identify the symbols for me where my proximity percentage is 1%. Now, what do I mean by that? That I'm telling the screener to identify symbols where the current candle is within 1% to a demand area or a supply area. So in a way, if I was manually going through, you would understand I would have to go through all those 40 symbols. But now it is telling me that you just have to go through these three symbols if you're looking for short opportunities, and these two symbols if you're looking for long opportunities. So as an example, if I go to LTIM, you will see that the current candle will be pretty close to a demand zone, because that is what it is getting shortlisted. So here you can see we have a demand area, rally based rally, and we are pretty close to it, and that is the reason it got shortlisted for me. Similarly, if I go to Grasim, I will again be trading pretty close to a demand zone, and here you can see we again have a rally based rally demand zone, and we are pretty close to it, and it got shortlisted for us. Similarly, if I take example of ONGC, you will see on ONGC I will be closer to a supply area. So here you can see we have a drop based drop structure and we are pretty close to it. That's the reason it got shortlisted for us. So this is how the scanner works. It will shortlist for you based on your proximity percentage, and it can be applied to any time frame. Like currently I'm on the daily. Now if I go to the weekly, you will see that it will start giving me results based on the weekly time frame. So let's just give it a few seconds because it has to go through all those 40 symbols and identify. So here you can see it is telling me only on Bajaj Finance I'm closer to a demand area. So if I go to BAJFI, Bajaj Finance. So you'll see on the weekly time frame, we have a zone here, and you can see we are trading pretty close to it, and that is what the screener is all about. So on screener, you can add any symbol which is available on Trading View. So again, these are a few examples of different scanner screeners. Again, your step number 2 is to get a smaller list. How you do that, it's completely your choice. I showed you over 150,000 scanners which are based on conventional technical analysis or fundamentals. I showed you 2 scanners which are purely based on demand supply zones. And the process can be as simple as I don't want to use any of these scanners. I want a small list. Therefore, I'll only be analyzing my Nifty 50 stocks. Or maybe I have my own favorite list of stocks which I want to analyze every day. So it is your choice how you want to get that small list, but definitely the more that list is in sync with demand supply methodology, the probability of finding opportunities definitely increases. But yes, your call at the end of the day, which way you want to get those symbols. Now, once you have that list, now you will have to analyze them one by one. Whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So let's assume that the very first symbol we got was ABC. So what am I supposed to do next? On ABC, I need to go to the lower time frame. So the question here is, what is my lower time frame? We got the answer from our step number 1. That as a monthly income trader, my time frames were monthly, weekly, daily, and 60. And out of this, daily was my lower time frame. So here lower time, sorry, not 60. Here lower time frame implies daily time frame. And what am I supposed to do there? I need to identify a zone. By zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's assume that this was the very first symbol that the scanner shortlisted for me. Now, irrespective of whatever scanner you were using. Now, when it comes to demand supply methodology, always say demand supply is a price action based methodology. Price action. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Price can only do 2 things. It can either move up or move down. It cannot do anything else. But when price is moving in a narrow range, we call it as the period of pause, or we can also call it as the base. Now, when we start learning demand supply methodology, initially our eyes are not trained to identify these structures. So that is the reason we start with a concept which is called as boring exciting candles, because it makes the process mechanical for us to start training our eyes. But eventually you will realize that every zone will not qualify based on the boring exciting technique, right? So most of the zones can be identified based on boring exciting technique, but not every zone. And that is when you start having that experience, you will start shifting from boring exciting to understand the period of pause or what the price action is showing me. Now, the boring candle indicator I have created for you is an absolutely free indicator. You can use it for free forever. So here you can see as soon as I applied the boring candle indicator, it is telling me that below the current market price, these 3 candles are my boring candles. Plus, I've also created another indicator which is called as an explosive move indicator, which I'm applying now, and you can see it is identifying all the explosive moves for me on this chart now. And this is also an absolutely free indicator. You can use it for free forever. And now you can see by using both these indicators, I have identified my leg out, which is this explosive move. I've identified my basing. I've also identified my leg in. So we have a rally based rally structure available to us. And if I disable these two and now I apply the demand and supply zone indicator, you can see it is also identifying exactly the same zone for me. Now this is a subscription based indicator, but we do have the demo version available. If you go to the indicator option on TradingView and search for demo demand supply zone indicator, you'll be able to find it. You can try the demo version as long as you wish to. There are some limitations, but once you apply the indicator, you'll get to know what those limitations are. So the indicator is more like GPS, that now I don't have to identify the zones. It automatically identifies the zone for me, also plots the zone for me. And that is what you can see on the chart. So it is telling me that from the current market price, the nearest demand zone is right here. So let's mark this demand. So that's my step number 3, which now the indicator is doing for me automatically. Right, so let's change this to demand. All right, so step three was identify zone on the lower time frame. We have already done that. In fact, the indicator has already done that. Now, once you have identified the zone, you cannot trade it blindly. Next step is to qualify it. And for qualification, we have a two-step process. In step one, we'll qualify it based on certain conditions. And in step two, we'll qualify based on the booster scoring. So let's check the very first condition, that is the zone a case of level on top of level. Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And that is the reason we use level on top of level as the very first condition to verify. Now, how do we do that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones in the lower time frame. So again, when your intermediate time frame zone on the lower time frame divides into multiple zones, we call it as a case of level on top of level. So what we understand from here, that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame. So let's verify that whether we have that condition or not. So if I go back to my chart, we'll change my time frame to the intermediate time frame, in this case weekly. And here you can see on the weekly time frame, we do have this drop based rally structure available, which the indicator is identifying for us. And let's mark it with a different color. So the one in the pink is your intermediate time frame zone, and the one in the green is your lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. Now we do have a coinciding level, but do we have one zone or do we have multiple zones? Now, when it comes to cases of level on top of level, it is not mandatory that the other zones might be quality areas. So what I'll do is I'll change the indicator settings that I want all zones, not just quality zones. And now you can see we have exactly what I was talking about. We have our intermediate time frame zone, which on the lower time frame is getting divided into multiple zones. So that's the first one. That's the second one. So we do have a case of level on top of level, and in case of level on top of level, what we should be doing to have the highest probability stacked in our favor, we should be going with the lower zone. So that is what I'll do. That's the modification. And you can see that is the reason we always start with level on top of level as the very first criteria, because if some modifications are required, we are making those modifications before we move ahead. So yes, it was a case of level on top of level. We have already made those modifications. It's not because of a gap, therefore gap rules will not apply. Now pivot no authenticity, we do have a drop based rally structure, but we need not apply the rules of pivot and no authenticity. And the reason for that is, if you go to the rule book, you can see we have a rule which says that in case of level on top of level, there is no need to apply the pivot and no authentic rules. As being a case of level on top of level, that extra probability we are looking for is by default stacked for us. So pivot nor authentic is not applicable, and similarly unstable equilibrium can also be skipped, but it is not even a case of unstable equilibrium. So after applying all the applicable rules, is the zone qualified for us? The answer is yes, because it did not get disqualified due to any of these conditions. So since none of these conditions are getting applied other than level on top of level, they cannot disqualify the zone, and if the zone is not getting disqualified, it is a qualified area for us. So since the zone is qualified, now we can move ahead with the booster scoring. Now the first one is freshness, and you can see we came into the zone, and after coming into the zone, the we left the zone wherein the zone has already been tested. So a tested zone, though it is a shallow touch, we can give it a score of 1.5. Talking about strength, you can see the leg out is not explosive. We don't even have a follow through pattern. We'll give it a score of 0. Time at the zone, we only have one candle in the basing. Reward to risk ratio, we'll take it as an assumption. Just give me a second, please. Right. So now you might say, then why are we using a low quality zone? Because if you look at the booster scoring, it is telling us it's a low quality zone. And the answer lies again in the rule book. You can see in the rule book, I've given you certain characteristics of cases of level on top of level. Now, do not assume that these characteristics will always apply. They might apply, they might not apply. And even when they are getting applied, it is not mandatory that all these characteristics will be applicable. At times, one might be applicable, at times two, maybe at times all three. So the very first characteristic is, in case of demand, the lower zone might be tested by the upper zone. That is what we saw exactly in this case. Then it also says the next characteristic is that in case of demand, the lower zone might be lesser strength versus the upper zone. We also saw that the zone above has an explosive move, but the zone below is not even I'll say a continuation pattern, right? We don't even have a good move. And the third is, in case of demand, the lower zone might have more number of candles versus the upper zone. That is not getting applied in this scenario. But what you need to understand is that level on top of level basically implies that we are trading the intermediate time frame zone by fine tuning it on the lower time frame. So we have talked about this many times in the past as well. So if you think about it, what I'm basically doing is that if I wanted to trade this intermediate time frame zone, this is where my proximal would be, this is where my distal would be. If I would have gone for body to wick method, still my proximal line would be here. But now that I can see that this zone is getting divided into multiple zones on the lower time frame, so I'm trying to take a deeper entry. Yes, prices might react a little early, I might miss a trade, but if I'm planning a trade, I want to take the trades with the smallest risk, right, which is where my reward to risk ratios can be really nice. And that is what this has helped me. Being a case of level on top of level, I was able to fine tune my entry a little deeper into the zone. So going back to the rule book, it says that if you see these characteristics, those characteristics can be ignored, and you can do the rating of the zone based on the intermediate time frame. Now, very important, whenever you're applying this rule, your boosters which are already getting the highest score, we need not touch them. Only the ones which are not getting the highest score, we'll see that can we make this score a little better. So if I go to the intermediate time frame and talk about freshness, you can see on the intermediate time frame, this is a fresh zone. I can upgrade it to a score of 3. And talking about strength here, in fact, we have an explosive move. You will see that if I change my settings, now it is only identifying quality zones, and you can see it is identifying it as a quality zone, which means we have an explosive move. So this can also be upgraded to a score of 2. So something which was a low quality zone, because of this rule, got converted into a high quality zone. Instead of 6.5, now we have a score of 10 out of 10. Next, what is the location? If I go to the monthly chart, we have a lot of demand areas, but we don't have any supply. That is what you'll be seeing. And we have taken such cases many times in the past. So what I can do is exactly the same thing. I can take the most recent pivot high and draw my curve all the way to my demand area, because demand is still available. And you can see we are planning our trade middle of the curve, which is a score of 0. Now, middle of the curve, I would ideally want to be in an uptrend, but in this case, I think we were in sideways. Yeah, we are in sideways, which again gets a score of 0. Next, move from the zone. We already have a move which is more than 4 is to 1. Let's draw that and verify. So that's the entry point. Stop. Back to the entry point. So you can see we already have a move which is more than 4 is to 1, gets a score of 2. Level on top of level, yes, we'll give it a score of 1. For coinciding as well, we'll give it a score of 1. Trap in a way becomes irrelevant. Reason is because even if it is 0, we still have a type 1 trade, but I can give it a score of 1. And the reason for that is that if you just look at this area, just above our zone, if you look at almost, this area, okay, I was not able to draw the line very clean. So what I'll do is I'll take a straight line instead. So let's take a horizontal line. Can you see if I start pushing it up, you can see almost this area has been acting like support, right? Has been acting like support, almost support. Though I don't see it working like resistance, but if I push it a little above, you will see then this area right here has been working like resistance and also as support somewhere around here. Though a few whipsaws in between, but not something which is major. So it still looks like a pretty decent area of support and resistance, for which I can give it a score of 1, thereby making it a score of 10 out of 10 for quality and 5 out of 8 for probability. High quality, high probability, a type 1 trade. But I would also like to add, as we move forward, I will also show you that even though it is a high quality, high probability, we'll still call it as an aggressive trade. Now, why we will call it as an aggressive trade, I'll talk about it as we move ahead. Alright, so coming back to after boosters, we got to know this is a type 1 trade. Now, no matter how high the quality or the probability, like I always say, any trade can be a stopped out trade. So you need to be ready for the worst case scenario by doing your proper position size calculation. Whenever the prices are back, you'll have to re-verify. Does it still qualify based on your trade plan? If the answer is yes, we place our order based on the entry type, in this case type 1 trade. And once your order has been executed, last step is your trade management, where step 1 is 1 is to 1, we make it break even. And after that, if you get the opportunity to trail onto it, we start using our trailing stop loss. Now, why was I calling it as an aggressive trade? Because if you go to the rule book and you go to the action grid, so this is what the action grid tells us. that if you have a demand area on the lower time frame which is located at equilibrium location on the higher time frame, and your trend is sideways, then your action should be no action on that demand zone. So that is why I'll call it as an aggressive trade. Why? Because if I go with my trade plan tells me I should not be taking any action here, but the booster scoring is telling me that you can still take it as a type 1 trade. So a trade which the booster scoring is allowing me to take, but the rule book says this is not something you should be doing. Now I know I'm deviating from my trade plan, and that is why I'll be calling it as an aggressive trade. Now again, like I always say, that with time, with experience, if you want to make some modifications, those modifications can be done to the trade plan. Or to the rule book. A very simple example can be that eventually my rule can be okay, I'm at equilibrium location, I have a demand zone, but unless and until I'm against the trend, I'm perfectly fine with planning a long trade. So eventually this could also be a long trade because I'm not against the trend. Only when I'm against the trend, which is downtrend, then I should not be taking a long trade. Right. So those modifications can be done eventually based on your experience. But as of today, going with this trade plan, we will call it as an aggressive trade because we understand we are deviating from our trade plan. We are getting into a trade which the rule book does not allow us to take, but since the booster scoring is still giving us a green signal that yes, we can go ahead if you wish to participate, we'll call it as an aggressive trade. All right, so that takes care of our example for today's session. And before we move ahead, I would definitely like to add that if you're not subscribed to my channel, do subscribe to it. If you're liking this session, hit the thumbs up button, like the video, share the video with your friends, your family members. If you are into some trading groups where you know people who are interested in learning trading, or maybe your family members or your friends who are interested in learning trading, you can share the link to my course. You can share the link to these videos. That could be helpful to them. And again, I'll say that generally the timings of these sessions are fixed, but at times if I'm not available, they do get rescheduled. And that is where if you're subscribed to my channel, it's going to help you, notify you whenever these sessions are being conducted. If you are available, you can join in live. In case you're not available, not to worry, the recordings are available. You can go through the recordings later. So let's see what do we have in the chat box. I'll take some queries and then we'll be ending the session. मल्टीपल टाइम फ्रेम्स में डिमांड एंड सप्लाई जोन अलग अलग मिलता है तो कौन से टाइम जोन में एंट्री एग्जिट लेना है. See, I just went through the complete analysis, so this should help you in understanding that the SETS, which is your stop loss, entry, target, and size, they always come from the lower time frame. It is but obvious that once we move on to different time frames, on different time frames, we'll be having different demand areas, we'll be having different supply areas. But to participate in a trade, we always do it based on the lower time frame. How your all plan got entry majority of the times plan did not get entries. What is the magic? All right, so what you're saying is that how did we get entries in some of these trades in this week? Because most of the times it does not happen. The reason why most of the time it does not happen, it's not that it's not happening. The reason is because I'm planning these trades on bigger time frames, right? We are planning MIT trades. So on MIT trades, your time frames are monthly, weeklies, dailies, which can take longer duration for the prices to come into the zone for the fills, and it can also take longer duration for these trades to play out, irrespective whether it is the stop loss or irrespective whether it is the target. Now yes, if I start planning uh, let's say DIT trades or HIT trades, then yes, you might see those trades getting triggered almost every other week. But challenges here are, one challenge number one is that I'm only sharing one trading idea with you once a week, right? So for that one single trading idea which I'm sharing with you once a week to get triggered, it can definitely take a longer period of time. Now when I'm just as an example, when I'm identifying trade setups for me, almost every other day I might be getting maybe 3 or 4 trade setups which I'm shortlisting for me, right? So during the week I can definitely get more number of fills, but since it is one session in a week, that too an MIT trade, so yes, the probability of getting the fill the same week might be a little less. And this is where once we start building up these examples, eventually prices will be coming to some of these demand supply areas. So there will be weeks where you will be having a lot of fills, then there will also be multiple weeks where we might not have a fill for even one of these examples. So it's just because of these factors: one, bigger time frames; two, that I'm only sharing one example for the week, which at times might not even get triggered. Now, if I show you some of the examples which I've shared with you in the past, you will see that we have missed a lot of them. Prices have already moved really far away from those areas and might not come back to those areas ever, right? So that can also happen. So it's just about the kind of trades we are planning and also the number of trades that I'm sharing with you per session. All right. Your options course is the best. All right. Thank you so much. I appreciate that. Can you please suggest some good books to read about price action and understand from basics? See, if you're talking about price action as in, demand supply methodology, then, my course is available. I'm not sure if I know any of the books which are purely on demand supply, but yes, for price action, you'll be able to find a lot of books. But since I have not read, I'll not be able to suggest any of these. So again, it's something maybe you can uh, if you're on some trading groups you can ask other people because uh, f- frankly I've not gone through any of these books any time in the past. All right. uh, all right, great. So you've already gone through the course. That's good. And this is what we do in these sessions. We apply whatever you have learned theoretically to some practical examples, which gives you a better understanding of how to plan trades using the methodology. All right. On a side note, do you look at sectoral rotation? If yes, can you share the logic in which you look for the rising sectors? No, I generally don't do that. I don't look at sectors. I just use my scanners. I get the list of symbols where we are maybe closer to demand or maybe closer to supply. Generally I only plan long trades, so when I'm doing it for myself I'm only looking for the ones which are closer to demand, and if they qualify based on my trade plan irrespective from what sectors they are, I'll simply take those trades, right? That is what I do. So I don't look into the sectors, but yes, I have done session where I have talked about how you can use these sectors for shortlisting symbols, right? And the title of that video, like always, give you example is uh, the top-down analysis. So you can just go through that video. That might help you in shortlisting, but not for anything else. Right. So very solid advice. Adhere to the training plan. Don't deviate. It is important to build good habits. Absolutely. All right. Great. So perfect. So that brings us to the end of today's session. Thank you so much for joining in. Next, I will be seeing you next weekend. Till then, trade safe. Enjoy your Sunday evening. Take care. Bye bye.